The Fed's response during the financial crisis was not purely monetary, however. In the first phase, from the fall of 2007 through the summer of 2008, its credit actions were sterilized. That is to say, lending through the term auction facility beginning in January of 2008, and lending in support of the merger of Bear Stearns and J.P. Morgan Chase that spring were offset by sales of U.S. Treasury securities from the Fed's portfolio, leaving the monetary base unchanged. Note that such sterilized actions are the equivalent of issuing a new U.S. Treasury debt to the public and using the proceeds to fund the lending, which I think quite clearly constitutes fiscal policy. It wasn't until September of 2008 that the supply of excess reserves began to increase appreciably. This expansion was accomplished through the acquisition of an expanding set of private assets by the Federal Reserve, loans to banks and other financial institutions, and later mortgage-backed securities and debt issued by Fannie Mae and Freddie Mac. While some observers describe this phase of the Fed's response as a standard monetary expansion in the face of a deflationary threat, the Fed's own characterization often emphasized instead the intent to provide direct assistance to dysfunctional segments of the credit markets. Clearly, an equivalent expansion of reserve supply could have been achieved via purchases of U.S. Treasury securities, that is to say, without conducting credit allocation. Like the Fed, the ECB, and many other central banks have also pursued credit allocation in response to the crisis. The impulse to reallocate credit certainly reflects an earnest desire to fix perceived credit market problems that seem to be within the central bank's power to fix. My sense is that the Federal Reserve's credit policy was motivated by a sincere belief that central banks have a civic duty to alleviate significant ex post deficiencies in credit markets. But credit allocation can redirect resources from taxpayers to financial market investors, and over time can expand moral hazard and distort the allocation of capital. This implies a difficult and contentious cost-benefit calculation. But no matter how the net benefits are assessed, no matter how you judge that trade-off, central bank intervention in credit markets will have distributional consequences. Central bank credit allocation is therefore bound to be controversial. Indeed, the actions taken by the Fed over the last few years have generated a level of invective that has not been seen in a very long time. Critics have sought to exploit the resentment of credit market rescues for partisan political advantage. While it's easy to deplore politically motivated attempts to influence Fed policy, we need to recognize the extent to which some measure of antagonism is an understandable consequence of the Fed's own credit allocation and credit policy initiative. The inevitable controversy surrounding central bank interventions in credit markets is one reason that many observers have long advocated keeping central banks out of the business of credit allocation. Central bank lending undermines the integrity of the fiscal appropriations process. And while U.S. fiscal policy making may not inspire much admiration these days, it is subject to the checks and balances provided for by our Constitution. Contentious disputes about which credit market segments receive support and which do not can entangle the central bank in political conflicts that threaten the independence of monetary policy making. The independence that modern central banks have to control the monetary policy interest rate emerged right after World War II, but it emerged in stages. The Treasury Fed Accord of 1951 freed the Federal Reserve from the wartime obligation to artificially depress the Treasury's borrowing costs. The collapse of the gold standard, we've heard about that earlier this morning, in the early 70s, and the attendant bouts of inflation led the Fed in 1979 to assert responsibility for low inflation as the primary objective of monetary policy. The independent commitment of central banks to low inflation provides that nominal anchor that substitutes for the anchor formerly provided by the gold standard. The substantial measure of independence central banks have been given was a key element in their relative success at sustaining low inflation over the last few decades. And while there are a range of plausible views now about inflation risks going forward, I think it's clearly the case that inflation performance over the last 2 decades, say, was far superior to that of the 70s and early 80s. In fact, many countries have adopted frameworks that hold their central banks accountable for a price stability goal, while allowing them to set their interest rate policy instrument independently in pursuit of their goals. This instrument independence within an accountability framework has been critical to insulating monetary policy making from election-related political pressures that can detract from longer-term objectives.